Welcome to the D-Risk Weekly Global Markets Brief. It is Saturday, December 6th, 2025. 2 weeks ago, we discussed the bad news bid, the market's paradoxical love affair with weak economic data. This week, that narrative has evolved into something more specific and structurally significant. We are witnessing the dollar capitulation. While equity markets are drifting in a holding pattern, the currency market has made a decisive move. The U.S. dollar index has broken critical technical support, signaling that investors are no longer just pricing in a December rate cut, they are positioning for a prolonged cycle of dollar debasement. This comes against the backdrop of stagflation lite data in the U.S., where manufacturing is contracting, yet prices paid are rising. The contradiction this week is stark. We have a breakdown in the global reserve currency, yet the VIX is asleep at the wheel, trading near 15. The market is effectively shorting the dollar to go long everything else, assuming the Federal Reserve will validate this trade next Wednesday. It is a crowded, high-conviction bet occurring in a vacuum of volatility. Alex, let's trace the impact of this weaker dollar abroad. Walk us through the action in Asia and Europe.
Thanks, Sarah. The dollar capitulation acted as a tailwind for international equities this week, masking some truly difficult local macro conditions. The theme across Asia and Europe is divergence. Markets are rallying on liquidity hopes, while the underlying economies struggle for traction. Let's start in Japan. The Nikkei 225 added 0.47% this week, closing at 50,492. The narrative here is shifting rapidly. We have reports that the Bank of Japan is preparing to hike rates to 0.75% in December to combat sticky inflation, which has pushed the 10-year JGB yield to an 18-year high of 1.93%. Despite the threat of higher borrowing costs, the technical trend remains robust. The Nikkei is holding a confirmed golden cross, with the 50-day moving average at 48,923, sitting well above the 200-day at 41,420. Investors are betting that the government's new $135 billion stimulus package will offset the monetary tightening. Moving to China, the Seng Index rallied 0.87% to close at 26,085. This market is caught between two forces, domestic deflation and geopolitical relief. While manufacturing contracted for the 8th straight month, the removal of certain U.S. tariffs under the incoming Trump administration provided a sentiment boost. Technically, the index is in a golden cross formation. The 50-day is at 26,203 and the 200-day is at 24,544. However, note that the close-in price of 26,085 is currently trading slightly below that 50-day line, indicating that while the long-term trend is up, short-term momentum is consolidating. In Europe, the disconnect is even wider. Germany's DAX rose 0.80% to finish at 24,028. Industry groups are calling this the deepest crisis since World War II, citing a collapse in exports. Yet the index remains in a pristine golden cross, with the 50-day at 23,973 above the 200-day at 23,528. The market is treating the economic collapse as a guarantee of ECB dovishness. Finally, the UK's FTSE 100 was the outlier, sliding 0.55% to close at 9,667. With private sector employment dipping and the Bank of England warning of fragile credit markets, the mood in London is cautious. Despite the weekly slide, the technicals hold. We still see a golden cross with the 50-day at 9,599 above the 200-day at 9,015. Sarah, the international signal is clear. Bad local news is being offset by the global liquidity signal coming from a weaker dollar.
It is a fragile dynamic, Alex. Europe and Asia are relying on the currency effect to paper over structural cracks. If the dollar were to suddenly snap back, that support beam would collapse. This brings us to the center of the storm. The U.S. market seems to be holding its breath. We have the Federal Reserve meeting just days away, and while the international desks are making moves, U.S. price action feels like the calm before the storm. Is the U.S. participating in this dollar capitulation trade, or are we seeing hesitation?
The U.S. is absolutely the epicenter of this move, Sarah, but the equity market is playing it cool while the plumbing undergoes a major shift. First, let's look at the equities. It was a muted week. S&P 500 futures drifted higher by just 0.17% to close at 6878, while the Nasdaq 100 futures added 0.43% to finish at 25,732. Both indices are effectively treading water, waiting for the Fed to confirm the rate cut bets. The price action is non-committal, consolidating recent gains rather than chasing new highs. The real story, and the anchor for our weekly theme, is the U.S. dollar index, DXY. It fell 0.47% to close at 99.00. This is technically significant. We are looking at a confirmed death cross, where the 50-day moving average of 99.00 has crossed below the 200-day moving average of 100.00. The market is technically validating a long-term bearish trend for the greenback. This is the engine driving the everything rally in risk assets. Now, look at how this impacts commodities. Gold consolidated this week, slipping a fractional 0.13% to close at $4,213. Despite the pause, the trend is incredibly strong. We have a wide golden cross, with the 50-day at $4,061, significantly above the 200-day at $3,486. Gold is comfortable above $4,200, pricing in both the weaker dollar and the geopolitical friction we are seeing globally. Oil, however, gave us a head fake. WTI Crude rallied 2.61% to close at $60. Do not mistake this for a recovery. This is a volatility spike driven by geopolitical headlines, specifically the Russia-Ukraine tensions and paused OPEC hikes. The technical reality is bearish. Oil remains in a death cross, with the 50-day SMA at $60 trading below the 200-day SMA of $64. The price is capped exactly at that 50-day line. The structural trend is down, driven by surplus supply forecasts for 2026. Finally, we check the pulse of the market with the VIX and rates. The VIX dropped over 2% to 15.41, signaling complacency. Meanwhile, the 10-year Treasury yield ticked up to 4.14%. This divergence, yields drifting up while the dollar breaks down, suggests the bond market is worried about that stagflation light scenario you mentioned, Sarah. The market is calm, but the cross-asset signals are flashing warnings.
Thanks, Alex. That disconnect between a breaking dollar and rising yields is the critical risk to watch. The market is betting the house that the Fed will solve this riddle next week. Looking ahead, the calendar is dominated by one event, the Federal Reserve interest rate decision on Wednesday, December 10th. The market is priced in a cut. Anything less than a dovish confirmation could trigger a violent reversal in the dollar capitulation trade. We also have the FOMC economic projections, which will tell us if the Fed sees the same stagflation light risks that the bond market is sniffing out. Before that, watch for Japan's GDP data on Sunday and Governor Bailey's speech from the UK on Thursday. But make no mistake, next week is all about the Fed. If Powell pushes back against the easing narrative, the liquidity trapdoor could open. That's all for this week's episode. Remember, this podcast is for informational purposes only and isn't financial advice. Do your own research or consult with qualified financial advisors before making any investments. Thanks for tuning in, and catch you in the next episode.